The Unshakable Pillars of Prosperity, an 80-year treatise on boring, brilliant investing. Let me tell you something you might not want to hear, but that you absolutely need to understand. After nearly 8 decades navigating the turbulent seas of the global financial markets, through wars, recessions, manias, and panics, I have arrived at a single, inescapable conclusion that most people spend a lifetime trying to avoid. The greatest wealth is not built through thrilling exploits or clever gambits. It is forged in the quiet, monotonous furnace of patience and passivity. The most lucrative investments I have ever owned are, without exception, crushingly boring. They are so mundane that describing them feels like explaining the chemical composition of paint as it dries. People's eyes glaze over. They lean in, expecting a secret formula whispered from the halls of Wall Street, only to be handed a farmer's almanac and told to plant an oak tree. They want complexity, believing that riches must be as intricately coded as a cipher. I offer simplicity, which to many feels like an insult to their intelligence. Yet this simplicity is the master key. These investments are the set-it-and-forget-it assets, the ones you can tuck away and ignore for decades, only to find they have performed the quiet, mechanical miracle of compounding your capital while you slept, worked, and lived your life. Some may call this philosophy lazy, believing that diligence must equate to daily activity, that sweat must be visible on the brow of a true investor. I have always contended the opposite. If your investment strategy delivers regular excitement, it is likely delivering subpar returns. The goal of investing is not entertainment. It is not to feel the rush of a speculative win. The goal is profoundly practical: to systematically outpace the relentless erosion of inflation, to preserve and then enhance your purchasing power, and to build wealth so steadily that you cease to worry about it. You want your money to be a silent, diligent partner, not a temperamental client demanding constant attention. And there are investments that do exactly this. They are accessible, understandable, and remarkably forgiving. They require no genius, no privileged information, and certainly no life spent chained to a Bloomberg terminal. They demand only 2 things from you: initial understanding, and then the monumental, often human discipline to leave them utterly alone. The first is easy. The second is the crucible in which financial futures are made or broken. The restraint not to meddle, not to panic, not to chase. This is where the real battle is fought, not in the markets, but within your own psyche. Today, I wish to walk you through 5 such pillars of a sound financial life. They are not flashy. They will not be featured on the front page for a dramatic surge, but assembled with care and left to work over the span of a lifetime, they form an almost impregnable fortress for your capital. Let us begin with the cornerstone, the single most important financial innovation for the everyday person in the last century. The foundational bedrock, the low-cost, broad-market index fund. If I could inscribe one financial commandment onto stone tablets for posterity, it would be this: Thou shalt own the market cheaply and forever. For over 50 years, I have evangelized the sublime logic of the index fund, a tool of such elegant simplicity that it is often mistaken for a child's toy by those seeking sophistication. It is not. It is a scalpel in a world of financial cudgels. An index fund, at its core, is a collective trust that buys a tiny, proportional slice of every company within a designated benchmark. The most famous of these is the Standard & Poor's 500 Index, a collection of 500 of America's largest and most significant publicly traded companies. When you buy a single share of a low-cost S&P 500 index fund, you are not betting on a company, you are betting on the collective ingenuity, resilience, and productive capacity of the American economy itself. You become a part owner of Apple's design prowess, Microsoft's software ecosystems, Johnson & Johnson's healthcare networks, Visa's payment rails, and the energy, industrial, and financial giants that form the backbone of commerce. You are buying in one fell swoop a diversified, self-cleansing portfolio. The self-cleansing is critical. As companies rise, they carry more weight. As they fade and are replaced, they are removed. The fund is a mirror to the market's perpetual Darwinian competition, and you are simply holding up the mirror. The active investor labors under the crushing burden of three near-impossible tasks: selecting which stocks will outperform, picking winners, timing when to buy and sell them, timing the market, and doing all this while overcoming the friction of commissions, taxes, and fees. The index fund investor does none of this. They acknowledge a humbling truth. They do not know which company will triumph next, nor when the market will turn. So they buy all of them and they hold forever. This passivity is not ignorance, it is wisdom. It is the recognition that the aggregate growth of corporate profits over time is a far more reliable and capturable force than the fleeting success of any individual stock pick. The historical arithmetic is compelling. Since its modern inception in 1957, the S&P 500 has delivered an average annual return of approximately 10%. This is not a smooth ride. It is a path strewn with stomach-churning declines of 30, 40, even 50%. But the long-term trajectory through every war and crisis has been upward. Adjusted for the historical average inflation rate of about 3%, this yields a real return of 7%. This is the 7% magic number. At a 7% real annual return, the purchasing power of your money doubles roughly every decade. A $10,000 investment becomes $20,000 in today's dollars in 10 years, $40,000 in 20, $80,000 in 30. This is the quiet engine of wealth. The enemy of this engine is cost. The index fund's power is neutered if it is wrapped in high fees. This is why I insist on low cost. Seek out funds from pioneers like Vanguard or from other reputable houses like Fidelity or Schwab with expense ratios of 0.03% to 0.10% per year. Compare this to the typical actively managed mutual fund charging 1% or more. That seemingly small difference of 0.9% per year, compounded over 40 years, can consume nearly a third of your potential wealth. You are not paying for performance. You are overwhelmingly paying for underperformance and lavish marketing. My famous $1 million bet, made in 2007 and concluded in 2017, put a fine point on this. I wagered that a simple, low-cost S&P 500 index fund would outperform a hand-picked portfolio of 5 elite hedge funds. These funds employed armies of brilliant analysts, leveraged complex derivatives, and charged 2 and 20, a 2% annual fee plus 20% of all profits. After 10 years, the result was a rout. The index fund returned 7.1% compounded annually. The hedge funds returned 2.2%. The index fund won by a country mile, demonstrating that complexity and cost are a dead weight on returns, not a propeller. Therefore, let this be the core of your strategy: a significant, unwavering allocation to a low-cost, broad-market index fund. Make regular contributions to it. Automatically reinvest all dividends. Then, and this is the hardest part, close the account statement and go read a book. Your future self will thank you for your magnificent, profitable boredom. 2. The Silent Guardian, Treasury Inflation Protected Securities. Tips.
If the index fund is the growth engine, think of TIPS as the shock absorber and inflation insurance policy of your portfolio. They are, to be frank, about as exciting as watching a tree grow. But when a storm hits, you are profoundly grateful for the deep, unwavering roots. A conventional bond makes a simple promise. We will pay you X% interest for Y years and then return your original principal. The fatal flaw in this contract is that the original principal and the X% interest are fixed in nominal dollars. If inflation averages 5% during the bond's life, the purchasing power of both your interest and your returned principal is severely eroded. You get your money back, but it buys far less. TIPS are engineered to solve this precise problem. They are U.S. government bonds, thus carrying the full faith and credit of the United States, but with a revolutionary twist. Their principal value adjusts monthly based on the Consumer Price Index. The interest rate is fixed, but it is applied to the inflation-adjusted principal. When you hold a TIPS
3. The endurance champions, dividend aristocrats, and consistent growers. While the index fund owns the entire market, there is a compelling subset of equities that deserve special consideration for their behavioral and financial merits, the long-term dividend growers, often called dividend aristocrats or dividend kings. A dividend aristocrat is a company that has increased its annual dividend payout for at least 25 consecutive years. A dividend king has done so for 50 or more years. This is an extraordinary feat. It means the company has increased its shareholder payout through the oil crises of the 1970s, the Black Monday crash of 1987, the dot-com bust, and the global financial crisis of 2008. Such a record is not an accident. It is a blazing signal of corporate resilience, financial discipline, and shareholder-friendly management. What does it take to raise a dividend for half a century? It requires a business model with enduring competitive advantages, a moat, a fortress-like balance sheet with manageable debt, and most importantly, the generation of copious, consistent free cash flow. Companies that can do this are typically in stable, often boring industries: consumer staples, Coca-Cola, Procter & Gamble, healthcare, Johnson & Johnson, and industrials, 3M, though even champions can stumble. They sell products and services the world needs and uses regularly, regardless of the economic cycle. Investing in such companies offers a powerful psychological and financial benefit. Financially, you benefit from the dual return engine, potential capital appreciation, and a growing income stream. That growing income is crucial. If you reinvest those dividends, you are buying more shares at regular intervals, accelerating the compounding process. During market downturns, your dividend buys more shares because prices are lower, effectively putting the power of dollar-cost averaging on autopilot. Studies such as those from Ned Davis Research and others have consistently shown that over long periods, dividend-paying stocks, and particularly dividend growers, have outperformed the broader market with less volatility. Psychologically, a growing dividend is a tangible signal of health. When the market panics and sends share prices down 30%, seeing that quarterly dividend land in your account and knowing with high confidence it will be larger next year is a powerful tonic against fear. It transforms a stock from a speculative piece of paper into a cash-flowing asset, like a rental property. This tangible return can steady your hand and help you abide by the first rule of lazy investing: do nothing. You can access these companies through low-cost index funds that focus on dividend growth, for example, ETFs that track the Dividend Aristocrats Index, or through careful individual selection. The fund route offers instant diversification and is lazier. The individual route requires more homework but can be rewarding. Either way, the principle is the same. Align yourself with businesses whose fundamental imperative is to return more cash to you year after year through thick and thin. 4. The passive landlord, real estate investment trusts, REITs. I have often said that buying a personal home is not primarily an investment. It is a consumption decision with associated costs and hopefully some price appreciation. Professional income-producing real estate, however, is a distinct and powerful asset class. It offers the potential for attractive income, inflation hedging, and diversification. The traditional barriers are immense: large capital requirements, management headaches, and illiquidity. The real estate investment trust is the brilliant financial innovation that demolishes these barriers for the everyday investor. A REIT is a company that owns, operates, or finances income-producing real estate. By law, to qualify as a REIT, it must pay out at least 90% of its taxable income to shareholders as dividends. This creates vehicles that often offer yields significantly higher than the average stock. The lazy investor's advantage is profound. By buying shares of a REIT in your brokerage account, you become a fractional owner of skyscrapers, shopping malls, apartment complexes, hospitals, data centers, or cell phone towers. You collect quarterly dividends, but you are blissfully free of the burdens of being a landlord. No 2 a.m. phone calls, no roof replacements, no property tax disputes. Professional managers handle all operational details. REITs provide two key portfolio benefits: diversification. Real estate values and income streams do not always move in lockstep with the stock market. Adding REITs can thus smooth your portfolio's overall returns, reducing volatility. Inflation hedge. Real estate is a tangible asset. Lease agreements often contain annual rent escalators tied to inflation. As the cost of living rises, so too can the rents collected by the REIT, which in turn supports its ability to maintain or grow its dividend. Not all REITs are created equal. I favor those that own mission-critical, needs-based properties. Think of infrastructure, cell towers, data centers, logistics warehouses, and healthcare facilities. The world may shift from malls to e-commerce, but it will always need to store data, connect calls, and treat patients. These are moats in the modern economy. Like all equities, REITs can be volatile, particularly sensitive to interest rate movements. But for the long-term, lazy investor, these short-term fluctuations are noise. The signal is the long-term collection of a growing stream of income from tangible assets, all without ever fixing a toilet. You can buy a low-cost, diversified REIT index fund and capture the entire sector, embodying the same lazy, powerful logic as the broad market index fund. 5. The ultimate asset, investing in yourself. This final pillar transcends the brokerage statement, but it is the bedrock upon which all financial security is built, especially in youth. Your most valuable asset is not your stock portfolio, it is your human capital, your future lifetime earning power. Investing in yourself is the highest return activity you will ever undertake. It is also, initially, the least lazy. It requires effort, time, and often upfront cost, but the returns compound in the most powerful way possible. They amplify your foundational ability to generate the very savings you will deploy into the other 4 lazy investments. Consider the math. If you earn $60,000 per year and invest $5,000 in a course, certification, or degree that increases your earning capacity by just 10%, you gain an extra $6,000 per year. Over a 30-year career, that's $180,000 in pre-investment income. If you save and invest even a portion of that differential, the final sum is staggering. Unlike a stock, this asset is permanently yours, immune to market crashes, and inherently inflation-resistant, as skilled labor commands rising wages over time. My own best investment was not a stock. It was a $100 Dale Carnegie public speaking course I took as a young man. That course, which terrified and then liberated me, paid compounding dividends for a lifetime. It opened doors to teaching, to communicating ideas effectively, to building relationships of trust. The return on that $100 was essentially infinite. This investment takes many forms: formal education, professional certifications, learning a high-value skill, coding, data analysis, project management, reading voraciously, or finding a mentor. It is the act of deliberately making yourself more valuable to the marketplace. The lazy dividend comes later. Once the skill is acquired, it pays out every single day of your working life, automatically boosting your capacity to save and invest. It is the ultimate set-and-forget investment in your own potential.
The synthesizing principle, the alchemy of compounding, and the war against yourself. These 5 pillars, the broad market index fund, TIPS, dividend growers, REITs, and yourself, are not isolated tools. They are interconnected parts of a philosophical whole. What unites them? They are all designed to beat inflation over the long run. Stocks grow because businesses can raise prices. TIPS are indexed to it. Dividends are raised to outpace it. Rents rise with it. Your skills become more valuable because of it. They are a collective answer to the silent thief. They benefit from and require long-term compounding. Compounding is the foundational force. It is not linear growth, it is exponential growth, where returns generate their own returns. A single dollar invested at 10% for 40 years becomes $45. The key is not to interrupt the process. The lazy investor, by trading rarely and holding forever, minimizes interruptions from fees, taxes, and mistimed decisions. They transfer effort from the investor to the investment. Your job is not to outsmart the market. Your job is to own the market and the assets that work within it, and then to get out of their way. The companies work, the properties generate rent, the bonds pay interest, your skills earn wages. Your activity is front-loaded in the selection and allocation. Thereafter, your virtue is inaction. This leads to the greatest enemy you will face. It is not a recession, a bear market, or even inflation. The enemy is you. It is the emotional whirlwind of fear and greed that lives in every investor's heart. The market will crash, perhaps by 30% or more, several times in your life. The instinct to flee, to preserve what's left, will be overwhelming. Conversely, the market will also soar into euphoric bubbles. The instinct to pile in, to chase the hot trend, will feel like a moral imperative. The lazy strategy is a bulwark against these instincts. By having a plan built on dull, durable assets, you have a script to follow when panic or mania hits. Your instruction is simple: hold, continue, rebalance if you must, but do not abandon. The data is brutal on this point. Studies by firms like Dalbar consistently show that the average investor dramatically underperforms the very funds they invest in because they buy high after gains and sell low after losses. The irony is exquisite. By trying to be clever and avoid pain, they lock in underperformance. By being lazy, by simply matching the market's return through a low-cost index fund, you are almost guaranteed to finish in the top half, and likely the top quarter, of all investors, professional and amateur alike. In the world of investing, ordinary is extraordinary. A practical blueprint for a lifetime. So, what does this look like in practice? Let us sketch a blueprint across a lifetime. In your 20s and 30s, your greatest asset is your human capital. Aggressively invest in Pillar V. Your savings rate is more important than your rate of return. Allocate the majority of your investment portfolio to Pillar 1, a low-cost global or U.S. total market index fund. Consider a small seed allocation to Pillar 3, dividend growth, and Pillar 4, REITs, for diversification. Ignore tips for now. Your long time horizon is your inflation protection. Automate everything. Set up automatic monthly contributions and dividend reinvestment. Then focus on your career and your life. In your 40s and 50s, you are in your peak earning years. Your portfolio is growing. Maintain your heavy equity allocation, but begin to introduce Pillar 2, tips, as a ballast. Perhaps a 10 or 20% allocation to tips starts to make sense. Stay the course with your index funds and dividend growers. Avoid the temptation to get more sophisticated as your balance grows. Complexity is still the enemy. In your 60s and beyond, capital preservation and income become more important. Gradually increase your allocation to tips and high-quality dividend growers to provide a reliable, inflation-protected income stream. You may even create a bond ladder of tips to fund specific years of retirement. But do not abandon equities entirely. A 60-year-old may still have a 30-year time horizon. A 40% allocation to stocks via your index fund is often prudent to ensure your capital continues to grow and outpace inflation deep into retirement. Throughout all stages, your portfolio is a garden. You planted sturdy perennial crops, the index funds, the dividend growers, the REITs. You installed an irrigation system, automated contributions. You built a fence against pests, tips for stability. Your job is not to dig up the seeds every week to see if they're growing. Your job is to weed out the emotional impulses, fear, greed, impatience that threaten to trample the garden. Then you wait. Season after season, year after year, the garden grows on its own. Conclusion: the sublime power of boredom. I have seen it all. The go-go years, the nifty 50, the stagflation of the 70s, Black Monday, the dot-com frenzy, the housing bubble, and the cryptomanias. Through every cycle, the same pattern repeats. The frenetic, excited traders eventually bleed capital, while the patient, boring holders of productive assets grow wealthy. Wealth is not built in the lightning strike of a lucky gamble. It is built in the gradual, imperceptible accumulation of sunlight and rain on a well-tended field. It is the sum of 1,000 small, prudent, unexciting decisions. The investments I have outlined are not secrets. They are not glamorous. They are the plain, sturdy tools of the financial craftsman. Their power lies not in their complexity, but in their reliability, and in your ability to pair them with the rarest commodity in the financial world, time, underpinned by temperament. So start where you are. Open an account. Buy the broad market fund. Invest in your skills. Automate your contributions. Then close your laptop. Go for a walk. Read to your children. Master a hobby. Build a life so rich in experience and connection that you forget to check your portfolio for months at a time. Let the market's daily gyrations, the breathless commentary, the promises of quick riches become background noise to a life well lived. In 30 or 40 years, you will not remember the specific headlines of a random Tuesday's market panic, but you will be profoundly aware of the financial security and freedom that your younger self's discipline, your magnificent, profitable, unwavering laziness has bestowed upon you. That is the final, triumphant truth. In the relentless pursuit of wealth, boredom is not a side effect, it is the strategy, and it wins every time.